Today, we'll be talking about the various options that shareholders have to exit from a company. So the first one is the sale of shares to another party. It can be another future shareholder, an existing shareholder, to employees, or if it's listed on the stock exchange, on the stock exchange. And when this actually happens, the difference between the sales price and the cost base will be the capital gain or loss, which is reported on your income tax return. The next option is a share buyback, where the company itself buys back the shares from you as a shareholder. And in terms of the value that you receive from this company, a portion of it will reflect the initial capital that you invested into that company. And that will be a return of capital, and there'll be no CGT event which occurs with that. And hence there's no tax implications. But the difference between the value that they give you and that return of capital will be assessed as a deemed dividend. So just lastly, there are some considerations when you exit from a company. It has to be compliant with the Corporations Act. It also needs to be compliant with the company's constitution, which will be different from company to company. And just note that there will be deemed market value provisions that might come into play. So you can't necessarily just palm off your shares at a lower price, say to a related party, because then these provisions will kick into place. But just lastly, FTC, we've worked with a lot of investors. So CGT calculations is something that we do quite often. And we've optimized the corporate tax structures for a lot of investors and businesses. So if that's something that interests you, please reach out to the team.